Welcome to the Every Biz Daily podcast. Today, we're diving deep into the consolidated audited financial results for Reinet Investments S.C.A. for the year ended March 31st, 2025.
That's right.
You, the learner, asked us to really get into the weeds here, cut through the numbers, and figure out what actually matters in these financials. So our mission today is to unpack the key performance bits, identify the big strategic moves, and make sure you come away feeling pretty well informed about Reinet's year.
Absolutely. Let's do it.
So let's jump right in with the big picture. Their overall performance, how did they do?
Well, the headline figure really is the growth in their net asset value, the NAV. It hit $6.9 billion.
Wow, okay.
Yeah, which is an impressive 11.8% increase compared to the $6.184 billion from last year.
That's quite a jump.
It is. And what's really fascinating here, I think, is that this isn't just a one-off thing. It actually represents a 9.0% compound annual growth rate since, believe it or not, March 2009.
9% compounded since 2009.
Yeah. Shows a really consistent upward trend over, quite a long time.
That kind of sustained growth, yeah, it definitely catches the eye. And it's not just the total value, right? The NAV per share also saw a pretty significant rise.
Exactly. It moved up from 34.02 to 38.04 per share. So the underlying value for each shareholder has also increased quite a bit.
Right.
And, the chairman's commentary adds an important layer here. He points out that the market conditions in 2025 were, much more volatile compared to this sort of relative stability they saw in 2024.
Okay. That's context.
Right. So managing to achieve this level of growth in what sounds like a more challenging environment, it really underscores the resilience and performance of their investment portfolio.
That's a very interesting point. I mean, it's one thing to grow when everything's going up, right? But navigating volatility and still delivering these kinds of results, that speaks volumes. Okay, so let's delve into some of the key drivers behind this performance, starting with a really major event. The complete sale of their stake in British American Tobacco, BAT.
Yes, this is a significant move.
Yeah.
Reinet completely divested, sold off its remaining 48.3 million BOP shares.
All of them.
All of them. And that generated substantial gross proceeds of $1.627 billion.
Billion, wow.
Yeah. It really marks the end of a very long-standing investment for them.
That's a huge influx of capital. And it wasn't just the sale proceeds, was it? They also received dividends from BAT during the year.
That's right. They pulled in another $98 million in dividends during the year before the sale finalized. So yeah, it sounds like a very profitable conclusion to that whole chapter.
So why do you think they decided to exit completely right now?
That is the key question, isn't it? I mean, the report doesn't explicitly spell out the rationale, but this move likely reflects Reinet's evolving investment strategy, a shift. Yeah. After holding a pretty significant stake since way back in 2009, perhaps they just see greater opportunities now in other sectors or maybe other geographies.
Makes sense.
It feels like a strategic reallocation of capital, really, after a very successful investment. I mean, it generated an annualized return of over 11% since it kicked off after the spinoff from Richemont.
Over 11% annually. That's solid.
Very solid. And over those years, they received, get this, over $2 billion in dividends alone.
$2 billion in dividends just highlights the massive value that investment created for them.
Absolutely.
Okay, so a strategic pivot after a long and very fruitful relationship. Now, another major contributor to their NAV increase was Pension Insurance Corporation or Pension Corporation.
Yes, definitely. The increase in the valuation of Pension Corporation was actually the single biggest driver of Reinet's NAV growth this year.
Really? The biggest?
The biggest one. And interestingly, Pension Corporation itself had a record year for new business. Their premiums increased to $8.1 billion in 2024. That's up from $6.9 billion the year before.
So their own business is booming.
Exactly. And that organic growth within Pension Corporation, well, it clearly benefits Reinet directly as a major shareholder.
So Pension Corporation's success basically fuels Reinet's growth. And Reinet has also been getting significant dividends from them too, haven't they?
Oh, absolutely. A substantial stream of dividends flowing back to Reinet. They got $85 million in May 2024, then another €150 million in September 2024.
Wow.
And then an additional €212 million after the March 31st year end. So that last one won't be in these results, but It's coming.
Right. It'll show up next time. But still, that's serious cash flow strengthening Reinet's position.
Definitely.
And what about Pension Corporation itself? Is it financially stable?
Oh, yeah. The report indicates a really strong financial foundation. Their adjusted equity is sitting at £6.5 billion.
Okay.
And furthermore, their Solvency II capital ratio, which is a key measure for insurers.
Right. How well they can cover claims.
Exactly. It stood at a robust 237% at the end of 2024.
237%. That sounds very high.
Yeah. It is. It suggests a very, very strong capital buffer. And it's also worth noting they're a big investor in the UK economy themselves. They've deployed £30 billion, including almost $14 billion in private assets like housing and infrastructure.
So a growing and financially sound investment for Reinet. Okay. Now, Reinet also has this diverse portfolio of private equity and related partnerships. Let's touch on some key developments there. Maybe start with Trilantic Capital Partners.
Sure. With Trilantic, Reinet's total investment to date is around $522 million. And they've already seen $617 million in realization, so money back out.
More back than they put in already.
Exactly.
Yeah.
And there's still a remaining carrying value of $424 million on the books. So the focus there seems to be on, actively supporting the growth of the companies in the portfolio and getting them ready for potential future sales or other ways to cash out.
Right. Positioning for monetization sounds like maybe they're in a bit of a harvest phase with some of those Trilantic investments. What about TruArc Partners?
TruArc had a particularly active year. They had one significant investment exit that returned $55 million to Reinet.
Nice return.
Yeah. And they've also been deploying more capital. There was a $39 million commitment to something called the TruArc Structured Opportunities Fund.
Yeah.
That brings their total commitment to that specific strategy up to $55 million.
Okay.
Overall, Reinet has put $351 million into TruArc so far, and they still have $139 million in outstanding commitments.
Yeah.
And that Structured Opportunities Fund you mentioned,
yeah,
that launch is interesting. It seems to give them more flexibility in how they deploy capital, maybe different types of deals.
Right. Maybe not just straight buyouts. It sounds like Reinet is strategically spreading its bets across different private equity approaches. How about Coatue funds, tech focus there? Right?
Yeah, Coatue. Reinet invested $104 million in their funds during the year, and they still got another €105 million in remaining commitments. And Coatue's approach, as you said, it focuses on these structured investments in tech companies. The idea is to try and balance the potential upside, the big tech wins.
With some downside protection.
Exactly, which seems like a pretty prudent strategy, especially in a sector known for its volatility.
Yeah, that makes a lot of sense given the tech landscape lately. Okay, shifting gears, let's go to Asia. How did their private equity investments in that region perform?
It was a bit varied, actually. You had the Milestone China Opportunities Fund. They saw complete exits from several listed companies: cosmetics, e-commerce, biotech, medical consumables.
Sounds good.
Well, yes, but because they distributed that capital back, the overall investment value actually decreased on paper for Reinet.
Ah, okay. Distributions lowered the book value.
Right. But then, conversely, the Prescient China funds had a positive year. They seemed to benefit from improving market sentiment in China and some supportive government policies, so their value increased.
Interesting contrast within China.
Yeah. And then the Asia Partners funds, which focus more broadly on long-term growth in Southeast Asia, their investment value was pretty stable. So it really highlights the complexities of investing in different global markets, doesn't it?
Definitely a mixed bag in Asia. Okay, what about their more specialized venture capital stuff under Nano Dimension?
The report describes the venture capital environment as cautious,
right,
which isn't too surprising.
No, not really.
And while the underlying portfolio companies, the startups, they apparently achieved some notable breakthroughs, things in leukemia treatment, electric flight, at-home PCR testing.
Some cool stuff.
Yeah, some interesting tech. But the overall investment value within Nano Dimension actually decreased.
Why was that?
Due to a combination of capital distributions, like with Milestone, and also just lower overall valuations in the venture space generally. It reflects the broader sort of correction and adjustment happening in the VC market worldwide.
Right. Venture capital can definitely be higher risk, higher reward. It sounds like they're navigating that carefully. Okay, finally, in this section, let's look at their investments in U.S. land development and mortgages. How's that looking?
Well, this sector, obviously, it's closely linked to the housing market, so it's been influenced by, interest rate hikes and inflation.
Yeah, headwinds there.
Definitely. However, their specific focus seems to be on the Florida market, which has benefited from population growth, people moving there. That provided some support.
Ah, location matters.
It does. And they mention a key financing transaction that generated some liquidity for them. And overall, the investment value in this segment actually increased.
Despite the housing market pressures.
Yeah, seems so. Demonstrates the resilience, I guess, of certain regional markets like Florida.
Okay, that gives us a really good overview of their diverse investment activities. Let's move on to the dividend, always important for you investors out there.
Absolutely. So Reinet paid a dividend of 0.35 per share during the year that just ended. And looking ahead, they've proposed an increase. They want to pay 0.37 per share.
A little bump.
Yep, a 5.7% rise. That's slated for approval at the annual general meeting in September 2025. And the report also provides a clear schedule for when European and South African shareholders can expect those payments.
Good. A steady increase in returns for shareholders. Okay, now, let's talk about Reinet's financial strength overall. How's the balance sheet looking?
It looks exceptionally strong, actually. They reported a really significant increase in cash and liquid funds. It reached $1.819 billion.
Almost $2 billion in cash.
Yeah, and this substantial increase is largely, as you'd expect, down to the proceeds from that big BD sale.
Right, that cash had to go somewhere.
Exactly. And importantly, they also fully repaid all their bank borrowings back in January 2025.
No bank debt.
None. Leaves them with a very clean balance sheet. Their total future investment commitments, as of March 31st, stand at a pretty manageable €417 million.
Which is easily covered by that cash pile.
Comfortably covered by their liquid assets, yeah. So this gives them considerable firepower, you could say, for future opportunities.
That huge cash reserve definitely positions them well, doesn't it? Okay, finally, let's just touch on the risks they see looking ahead and their general outlook.
Well, the report does acknowledge the potential for continued market volatility and, general global economic instability. It sort of echoes the chairman's earlier concerns.
So they're aware of the choppy waters.
They are. And their strategy moving forward is described as maintaining a, quote, measured approach to deploying capital. So focusing on supporting their existing investments first.
Taking care of what they have.
Right. And then selectively exploring new opportunities only where they see really strong potential. And they also explicitly stated, which is relevant these days, that they have no direct exposure to Russia, Ukraine, or the Middle East.
Good to know. So basically a position of strength, but a cautious yet opportunistic outlook.
That sums it up well.
Okay, so let's try and unpack what this all means for you, the learner. Reinet has clearly had a very strong year. It was really driven by that successful and profitable exit from Bay and also the significant growth within Pension Corporation.
Yeah.
And this has resulted in them having this substantial cash position, but also taking a sort of cautious approach to future investments in a world that's still facing ongoing economic uncertainty.
Here's where it gets really interesting, I think. If you consider how Reinet's diverse portfolio, spanning public stocks like Beatty was, private equity across different regions and sectors, even U.S. real estate, how that illustrates a strategy of managing risk and seeking returns in really different economic environments.
Diversification in action.
Totally. And that significant increase in their cash reserves, well, it gives them considerable optionality, doesn't it?
Yeah.
Flexibility to capitalize on future investment opportunities as they pop up.
Right. So what does this all mean for your understanding of investment, perhaps?
Well, it underscores the potential value of long-term holdings like they had with Bettis, but also the impact of making strategic divestments at the right time. And just the constant need for companies to adapt their strategies in response to, global economic shifts.
Reinet's results really offer a real-world example of these principles playing out.
So this might raise an important question for you. How does Reinet's approach managing this diverse investment portfolio, realizing significant gains like the bad sale? How does that inform your own perspective on investment diversification and maybe strategic asset allocation in today's pretty complex world?
Yeah, it's worth thinking about their willingness to exit those long-held positions when opportunities seem to shift, and also their real focus on maintaining a strong financial position, that big cash buffer. Definitely. Okay, as a final provocative thought for you to chew on, with such a substantial war chest now, all that cash from the book sale, what might be the next significant deep dive for Reinet? Which sectors or maybe emerging markets might they be targeting as they look to deploy this capital for long-term growth in the years ahead?
Yeah, where's that $1.8 billion going to go?
Exactly. That's definitely something worth watching closely.